I'm now joined by Marc Ostwald, a fixed income strategist at Monument Securities. Thanks so much for coming to speak to us. So, your thoughts, your assessment so far of market reaction to Prime Minister David Cameron's proposed budget cuts?
I think it's been very lukewarm. I think it's also been looking in the wrong places at the moment. Actually, people are focusing very much on the changes in the regulation. They're focusing on the $6 billion of cuts. They should actually be looking at this change in capital gains tax to bring it into line with income tax, because that will fundamentally change, if implemented, the way people invest here in the UK, because you're at a stage then where people will be focusing much more on income growth. So that is absolutely critical. I think the next thing that people will be waiting for, and I think this is why the market reaction's been very lukewarm, is OK, they're going to do $6 billion of cuts, but what people want to know is what credible plan is there going to be to bring down the budget deficit in the long run.
So tell us more then about how these economic policies could potentially change the way people invest in the UK.
At the end of the day, if you raise capital gains tax to that sort of level, particularly the private investors will start looking at saying, well, actually, do I need to focus on making capital gains, which would be focused largely in the equity market and that would also affect their strategies in the bond market, or do I need to focus on a much more buy and hold focus strategy and focus on the income, whether it's and you then start looking at gilt yields relative to earnings yields on equities, and you say, well, actually gilt yields look very, very poor. So I think there's a fundamental rethink. The other thing that people need to remember is Mr. Osborne's promise, I know it was under a manifesto, Conservative manifesto, to rescind some of the raid on pension funds that Mr. Brown implemented when he came in 13 years ago. And we still need to hear some more details on that.
So what does all this mean for the UK economy looking ahead?
I think we're going to go through a lot of austerity, just like the rest of continental Europe. But in the longer run, actually, it may put it on a lot more stable footing. And I think actually people should give this government the benefit of the doubt in the first instance, and I don't think that's what's actually happening. Everyone, I think for the bulk of the marketplace, there's an assumption that at the very latest in 2 years this government will fail. I'm not sure that that's actually going to be the case.
Now moving to the broader picture, Spain's IBEX index jumped a record 14% 2 days ago. And the cost of insuring against default on Spain's largest banks fell to the lowest in 3 weeks on the Prime Minister's proposed budget cuts, austerity measures. I mean, what do you think? Is concern easing? I mean, is there more confidence that Spain will be able to stem contagion, if you like, from Greece?
I think the most important thing is that people are starting to believe that the Eurozone is actually headed down the right path.
Right.
Now, the question is, are they actually all going to achieve their various targets, Greece being the most important one, but Spain probably after that much more important in certain senses than either Portugal or Ireland, which has already implemented it. So I think the market for the time being, along with the ECB's interventions, or rather the national central banks, which are buying the government bonds, is willing to give them the benefit of the doubt. But are we actually going to bring these bond yields in the non-core, in the Club Med markets, down to the sort of levels we saw before? I doubt it very much. I think we'll leave a degree of risk premium there, but we still have scope for the spreads to tighten.
Yeah, well, Marc Ostwald, do appreciate your thoughts. Thank you very much for speaking to us.